They say every crisis has a different villain. Mortgages, oil shocks, hedge funds, pandemics, geopolitics, even just bad luck. But if you mute the commentators and just watch history unfold, something unsettling comes into view. The footage rhymes. Graphs separated by decades bend the same way. Liquidity disappears the same way. Policymakers react in the same rhythm. Denial, then delay, then emergency. Change the era, change the technology, change the central bank. Yet the architecture of failure refuses to evolve. It's as if the system isn't just reacting to shocks, it's designed to convert pressure into rupture. You can feel it before anyone admits it. The first sign isn't panic, it's absence. Bids don't just collapse, they evaporate. Instruments that traded smoothly yesterday suddenly feel heavy, like you're dragging something through deep water. This isn't sentiment, it's the architecture of the system withdrawing. Liquidity doesn't just fade, it's pulled back by invisible hands, protecting balance sheets long before the public even senses danger. The news narrative will blame inflation, war, elections, or just irrational panic. But beneath the surface, balance sheets are recalculating survival, collateral is being silently downgraded, and the leverage that felt harmless yesterday suddenly begins to sting. If you've ever watched a market fracture from the inside, when the trading screens go wrong before the headlines arrive, you know this texture. The system enters a strange, eerie quiet. Trading flows thin out. Dealers step back. A distinct chill settles over price action. It feels irrational, but only if you believe finance is a story about prices rather than plumbing. Crises don't start with fear. They start with the structure cracking. This video isn't about one specific crash, one single villain, or some mythical black swan event. It's about the repeating blueprint, a predictable three-phase cascade. First comes the fragility disguised as stability. This is the phase of suppressed volatility, where everything seems calm on the surface. Leverage quietly builds up, and a dangerous illusion of endless liquidity makes everyone feel safe. Risk is accumulating, but it's hidden from plain sight. Think of it as a dam with invisible cracks forming under the pressure of the water. Then comes the trigger. It's usually something small, almost unremarkable. A missed bid at an auction, a squeeze spread between two assets, an unexpected earnings miss, a small gap in the market's plumbing. To the outside world, it's just noise. But insiders, the ones who operate the machinery, recognize it as a signal, a message that the game has changed. That small crack in the dam has just begun to leak. And finally, the third phase, mechanical liquidation. This is when the system unravels. Margin calls are issued, forcing investors to sell assets into a falling market. This forced selling creates more selling, a feedback loop that accelerates the crash. Policymakers scramble to react, but it's too late. This part is always described as panic, as if it were a purely emotional reaction. But it's not. It's a mechanical, almost automated process, driven by the system's plumbing, not by fear. The dam doesn't just leak anymore, it bursts. We're going to walk through that blueprint like investigators returning to a crime scene. We will trace the footprints across 1929, 1987, 1998, 2008, and even 2020. We're not here to dramatize history, but to show you that the same fingerprints appear every single time. To understand this, you have to follow the incentive, not the headline. Because behind every crash is a mechanism that is designed to benefit someone. So if you've ever looked at a market implosion and thought, "I've seen this before," you're not imagining it. And if that sense of déjà vu unsettles you, you need to stay with us until the end. This pattern is real, and the reason they never explain it to you is darker than you might think. By the time we're done, you won't just recognize the shape of a crisis. You'll feel when one is forming, long before anyone dares to name it. We're told financial crises are accidents, black swan events, things no one could have possibly seen coming. After every crash, the committees and commissions and best-selling books all repeat the same story. It was a freak storm, a perfect storm, an anomaly. But is that true? What if we strip away the official narrative and just look at the raw data, at the plumbing of the financial system itself? If you go back far enough, you start to see a disturbing pattern. The mechanics of every major crisis repeat themselves with uncanny precision. The seeds of 2008 weren't just planted in the 90s. You can find their shadows in 19th century ledgers, in handwritten letters between bankers, and in forgotten congressional records. It's not because the world was simpler then. It's because structure has always determined collapse. The rhythm was already there. We just didn't have the words for it yet. Let's start in 1907, long before the Federal Reserve even existed. In New York, institutions called trusts were acting like modern shadow banks. They took deposits and made loans, but they were lightly regulated and had no central bank to bail them out if things went wrong. The trigger for the panic of 1907 was tiny, almost laughable, a failed attempt by a few speculators to corner the stock of the United Copper Company. It was a local, forgettable event, but the mechanism underneath was pure mathematics. Too much leverage was concentrated in a few key trusts. The collateral they held looked safe, until suddenly it wasn't. And when one domino tipped, their counterparties all demanded their cash back at once, from institutions that simply didn't have it. There were no headlines about global recession or inflation, just a silent, deadly shift in the system. Funding unavailable. Within days, long lines of depositors formed outside the Knickerbocker Trust. They weren't panicking because of a rumor. They were lining up because the liquidity had vanished before the fear even set in. This is the first element of the crisis blueprint. Stress always begins invisibly inside the balance sheets. It only becomes visible in the market price much later. Now, fast forward to 1929. The popular story is one of roaring 20s mania, a shoeshine boys giving stock tips, of irrational exuberance. But the insider's version of the story is far more boring and far more terrifying. The real engine of the boom was a fragile credit loop. Brokers were offering massive margin loans to speculators, funded by something called call money, which was short-term credit mostly supplied by non-bank entities. There was no lender of last resort. The true warning sign wasn't the famous crash in October 1929. It was months earlier, in the summer, when the rates on that call money suddenly spiked. It was a quiet signal, but dealers on the inside heard it loud and clear. They started quietly tightening their lending terms. The public narrative blamed wild speculation, but the structural truth was collateral depletion. The market didn't crash because stocks were too expensive. It crashed because the funding at the very top of a highly leveraged ladder suddenly dried up, and there was no one with enough cash to catch the falling knife. Let's jump to 1987. Traders who lived through it still talk about Black Monday with a mix of awe and bewilderment. The official story blames program trading, as if rogue computers took over Wall Street. But again, the structure explains far more. A new risk management strategy called portfolio insurance had become incredibly popular. It was designed to automatically sell stocks as the market fell, creating a supposedly stable, self-correcting system. The problem was, it created artificial liquidity that vanished the second it was actually needed. The mechanism was mechanical selling tied directly to price declines, creating a death spiral. But the most telling detail happened weeks before the crash. In the U.S. Treasury market, the safest, most liquid market in the world, tiny fractures started to appear. Bid-ask spreads widen. The market depth at key points on the curve would suddenly evaporate. It was small, quiet, and statistical. But to insiders, it was an unmistakable sign of stress. The public story blames computers. The blueprint reveals that stability engineered through feedback loops becomes extreme fragility under pressure. Then came 1998 and the collapse of long-term capital management, or LTM. The headline story was that a group of Nobel Prize-winning geniuses got arrogant and blew up their hedge fund. It's a great story, but it's a myth. The structural reality was about global leverage chains. LTM was at the center of a web of trades, all betting on the same thing: that interest rates around the world would converge. They used borrowed money from multiple banks, using the same collateral over and over again in a process called rehypothecation. LTM didn't just fail. Its failure sent a shockwave that pulled liquidity out of dozens of interlocking institutions simultaneously. It exposed a brutal truth. When everyone uses the same smart strategy, correlation becomes destiny. The crisis didn't begin when LTM officially defaulted. It began weeks earlier, when the big banks quietly reduced their risk appetite. The world didn't see it, but it was there in the market's whispers, disappearing bids for less common Treasury bonds. Again, the blueprint holds. The stress signal always appears first in the most liquid, supposedly safe parts of the system. And that brings us to 2008. The crisis everyone thinks they understand. Mortgages, subprime, knitting agencies, Lehman Brothers. We all know the buzzwords, but the deeper pattern is the same mechanical process. Assumptions about collateral quality in this case. Housing prices suddenly broke. Funding costs spiked. And then a cascade of forced selling began. Not out of fear, but because of the legal language written into contracts. Most people believe the crash began in September 2008, with Lehman's bankruptcy. But insiders know it really began a full year earlier, in August 2007. That's when the French bank BNP Paribas froze withdrawals from 3 of its investment funds. The reason they gave was critical. They cited an inability to value assets. Think about that wording. It wasn't fear, it was valuation uncertainty, which is just another way of saying, the plumbing is breaking, and we're quietly pulling our money out. This isn't just ancient history. The pattern repeated itself as recently as 2019. Out of nowhere, overnight lending rates in the U.S. repo market, the core plumbing for the entire financial system, spiked from 2% to 10%. The headlines screamed about a crisis nobody saw coming, blaming it on corporate tax payments. But insiders had been whispering for months about a growing scarcity of high-quality collateral. The real mechanism was simple. Big banks were hitting regulatory limits and didn't want to expand their balance sheets. So at 2:13 p.m. on September 16th, liquidity simply vanished. Nobody panicked. The system just hit a structural wall. It's the same blueprint, over and over again. Pressure builds silently within the system. It reaches a hidden threshold, and then, a sudden, violent rupture. The 2020 COVID crash? Textbooks will tell you it was pandemic panic. But if you look closer at the sequence of events, something else was happening. Before the lockdown headlines even hit, the U.S. Treasury market, the supposed bedrock of global finance, started to fracture. In early March 2020, market depth collapsed. Dealers, the big players who were supposed to make the market work, simply stopped taking the other side of trades. Bid-ask spreads, the gap between what a buyer will pay and what a seller will accept, widened by an astonishing 400%. Think about that. On the safest asset in the world, the cost of trading suddenly quadrupled. The headlines screamed fear, but the reality was a plumbing failure deep inside the financial system. This follows a blueprint we've seen time and time again. It's a critical lesson. The world's riskiest assets don't break first. The world's safest assets do. And that is the single most important historical signal that a crisis is underway. It's a pattern that repeats across history. Go back to the panic of 1907, the Great Crash of 1929, Black Monday in 1987, the long-term capital management crisis in 1998, the global financial crisis of 2008, the repo market seizure of 2019, and the COVID crash of 2020. Even in dozens of forgotten mini-crises, like in 1966, 1970, and 1994, the story is the same. After each one, the official narrative is always, "No one could have predicted this." It's a comforting lie. But the historical documents, the internal memos, the hearing transcripts, they all say otherwise, over and over again. Let's look at the evidence. In the aftermath of the 1907 crisis, transcripts from a 1908 Senate hearing show senators warning about the concentration of collateral risk. Sound familiar? Jump forward to 1932, and you can find a Federal Reserve memo detailing market seizures due to absence of dealer balance sheet capacity. After the 1987 crash, an internal report from a CFTC panel noted liquidity evaporating simultaneously across independent markets. Fast forward again to 2009, and a Bank for International Settlements paper described crises as feedback loops embedded in leverage mechanics. None of these explanations are dramatic, sensational, or emotional. They're not about panic or fear. They are structural. They are mechanical. The pattern is older than modern finance itself. It's baked into the design of our system. When a system artificially suppresses volatility, making everything seem calm and safe, it encourages leverage to expand. When the quality of collateral becomes something people just assume is good, rather than verifying it, risk builds up. And when liquidity, the ability to buy and sell easily, is treated as a permanent feature of the market, the stage is set. When the rupture finally comes, it always takes the same shape. The recurring lie is that crises are unpredictable black swan events. The recurring truth is that the system sends signals, clear as day, long before the popular narrative catches up. History isn't just a list of crashes. It's a list of whispers that were ignored. The earliest tremors don't come from the flashy stock markets you see on TV. They come from the quiet, hidden behaviors inside the balance sheets of major financial institutions. It starts with dealers stepping back, refusing to provide quotes for trades. They start tightening their lending terms, making it harder for others to borrow. They quietly begin hoarding cash and shrinking their own risk limits. These actions are almost always invisible to the public, but they are crystal clear to insiders. And this is where looking at history through the right lens becomes so powerful. The exact same warnings appear decades apart, in almost identical language. You find phrases like thin markets, depth concerns, collateral uncertainty, and funding tension in newspaper archives from 1907 and in Bloomberg chat transcripts from 2020. The language of crisis is timeless. The lie we tell ourselves is a cultural one. We believe markets move because of fear, greed, and big stories. The deeper truth is mechanical. Markets move because liquidity, the lifeblood of the system, changes direction. And liquidity changes direction because of incentives, not emotions. A dealer at a major bank doesn't wake up one morning and say, "I'm scared." They wake up, look at their risk models, and say, "My balance sheet is too tight to catch all this falling collateral." It's a cold, calculated business decision, driven by risk management and profit motives. Fear is the result, not the cause. It would be comforting to think that today, after a century of repeated crises, regulators have finally solved this pattern. But history shows they never really solve the pattern, they just move it somewhere new. Every solution creates a new, hidden fragility. In 1934, after the bank runs of the Great Depression, they created deposit insurance to protect bank accounts. The result? A massive shadow banking system grew outside of those protections. In 1971, when the U.S. ended the dollar's convertibility to gold, it was meant to give the system more flexibility. The result? The offshore euro-dollar market exploded, creating a vast, unregulated pool of dollars outside of the Fed's control. After 2008, regulators cracked down on big banks to make them safer. The result? The risk just moved into the less regulated world of private credit, which has ballooned in size. And after the Treasury market seizure in 2020, the Fed intervened to stabilize it. A good thing, right? Well, that intervention has made high-quality collateral even scarcer, creating a new set of problems. Every fix is just a migration of fragility. The risk moves to a different corner of the system, where it can grow quietly, invisible, until the next trigger comes along. By now, you might assume this is a story about a series of historical events. It's not. It is a story about a structure that never changes. History supplies us with dozens of examples, but they all trace the same invisible geometry, the same predictable sequence. First, leverage expands during a period of calm. Second, this causes fragility to accumulate in hidden corners of the system. Third, liquidity suddenly disappears, but it starts in the safest, most crucial markets first. And finally, the narrative arrives, late to the party, screaming explanations for something that was already over. The lie people believe is that crises appear suddenly, out of nowhere. The leak that exposes this lie is that liquidity, the very foundation of the market, begins to silently drain away weeks or even months earlier. It's a quiet retreat before the stampede. In the next part of this series, we will uncover that critical pivot point, the exact instant the system silently flips. We'll look at the moment when hidden fragility becomes a full-blown event. The switch that no one sees at the time, but everyone feels later. And once you learn to recognize this midpoint, this invisible turning point, the blueprint of every future crisis will reveal itself to you, long before the headlines ever arrive. There's a moment in every crisis when the story everyone sees and the mechanics underneath diverge. Outsiders see confusion, a shocking headline, a sudden price drop, a spike in volatility. But insiders, they see something different. They see geometry. They see a system crossing a hidden threshold. And here's the secret. That threshold almost never arrives during the peak drama. It arrives much earlier, quietly, when a system that was fragile but stable suddenly flips into a state of self-reinforcing instability. In physics, this is called a phase transition. In finance, it's often dismissed as nothing to worry about. But the charts, they tell a different story. The real shift happens when incentives realign. Think about it. A system that was rewarded for providing liquidity, for keeping markets running smoothly, suddenly finds itself rewarded for pulling that liquidity away. Dealers who spent months tightening the gap between buying and selling prices now have every reason to step back and let those gaps widen. This isn't about fear or panic. It's pure math. Capital charges, risk limits, regulatory buffers, the entire bureaucracy of a bankie's balance sheet quietly flips its switch from deploy to contain. It's a single policy change buried in a spreadsheet, but its consequences are cinematic. Liquidity doesn't just get a little tighter, it begins to accelerate away from anything that looks like risk. What makes this pivot so hard for most people to spot is that prices don't need to crash for it to happen. We're all trained to look for big, scary spikes in volatility. But what's far more sinister is when volatility drops in the wrong context. Low volatility combined with poor market depth, meaning very few buyers and sellers, is a terrifying sign. It's like a quiet room where you know something is wrong. Smooth market movements on shallow order books mean that a single shock, one unexpected event, can create a fracture. This is the moment when systemic fragility becomes a structural inevitability. The outcome is already baked in, even though the public won't feel a thing for days or even weeks. Every major crisis has a date that insiders remember. It's not the date of the crash itself, but the date of the inflection. For the 1987 crash, it wasn't Black Monday, October 19th. It was October 14th, 4 days earlier, when the depth in S&P futures just vanished during the afternoon. In 1998, it was August 17th, when Russia defaulted on its debt, and suddenly no dealer wanted to price anything honestly. In the run-up to 2008, the moment was August 9th, 2007, what's known as the BNP Paribas moment, when the value of collateral suddenly became uncertain. And before the 2020 crash, it was March 9th, when the US Treasury market, the safest market in the world, became disorderly before most people were even paying attention to lockdown headlines. Most investors miss this pivot because it usually looks like nothing. A slightly wider spread between a bid and an ask price. A government bond auction that technically clears but feels off. An overnight funding rate that jumps just a little too much. A popular ETF that, for one day, trades strangely thin. These aren't random glitches. They are the signatures of a profound transformation happening just beneath the surface of the screens. They mark the shift from the market as a pricing engine to the market as a stress amplifier. You might expect this pivot to be chaotic, but it's actually the opposite. It's eerily calm. This is when insiders start speaking in code. You'll hear phrases like, depth is a bit patchy, we're out of balance sheet, or the flows are all one-sided. To an outsider, these sound like harmless industry jargon. To those who understand the market's plumbing, they are blaring alarm sirens. Every single one of those phrases has preceded a major financial crisis in the last 40 years. The twist gets even sharper when you realize this pivot isn't psychological. It's contractual. It's not about fear. It's about the fine print. Margin rules, haircut schedules on collateral, prime brokerage agreements, dealer inventory limits, these are the real switches. A crisis isn't fear breaking loose. A crisis is when the language in a legal document activates, when leverage stops being rolled over, when collateral requirements tighten, when funding dries up not because of sentiment, but because of a rule. The system automatically begins to move toward forced liquidation. It doesn't matter what any individual trader feels or thinks. The public always believes a crisis begins with a big, external shock. But insiders know a crisis truly begins with a refusal. It begins when someone who is supposed to provide liquidity, who is supposed to be there to buy or sell, silently steps away. That is the moment everything changes. It's like that scene in a disaster movie where a door quietly locks in the background while the main characters are still talking. By the time they notice the locked door, their fate was sealed long ago. And here is the most breathtaking part. Once this pivot occurs, every price movement that follows is no longer random. It becomes directional, not because of a shift in sentiment, but because of a deep structural imbalance. The system enters what physicists call a metastable state. It looks calm on the surface, but it is mathematically guaranteed to break when it's disturbed. Any external shock, no matter how small, will trigger the liquidation machine that was just waiting in the wings. The ultimate twist isn't that crises repeat themselves. The twist is that they repeat because the core incentives cannot change. The structure of balance sheets, the logic of collateral, the fundamental nature of leverage, these things have remained constant through every technological revolution in finance. The architecture is mechanical, not emotional. And once that mechanism flips from providing liquidity to withdrawing it, the ending has already been written. The public will see the crash eventually, but the insiders, they see the pivot first. In our next video, we're going to expose the exact mechanism that drives this pivot. We'll look at the financial equivalent of a pressure valve buried deep inside the market's plumbing and map out precisely how it transforms invisible stress into a very visible collapse. There's a hidden mechanism at the center of every one of these repeating meltdowns. Once you see it, you'll never look at the financial world the same way again. This isn't about fear, politics, or complex psychology. It's about the very plumbing of the market, and it has a name. Liquidity, hierarchy inversion. It's the shocking moment when the safest, most stable markets suddenly become the most fragile. It's when liquidity, the ability to buy or sell, easily vanishes, right where everyone believed it was permanent. Understanding this inversion explains why crises often begin in U.S. Treasuries, not in risky penny stocks. It explains why we see volatility spike before the scary headlines even appear. And it reveals why central banks, no matter how much they try to guide the market, can't prevent these events. They only shift where the break will happen next. To really get this, we need to walk through how a supposedly stable system transforms itself into a machine that accelerates its own breakdown. What you're about to hear is a forensic map of that transformation, based entirely on public data and the same metrics that financial insiders track every single day, but rarely explain to the public. In normal times, you can think of global markets as a pyramid of liquidity. At the very top, you have U.S. Treasuries. They're the world's most accepted collateral, the deepest market, and the one asset everyone assumes you can always sell. Below that, you have other safe assets, then corporate bonds, stocks, and finally, at the bottom, the really risky stuff, like leveraged loans, private credit, and crypto. Textbooks tell us that crises start at the bottom of this pyramid, with the riskiest assets, and then spread upwards towards safety. But in reality, every major liquidity crisis of the last 25 years has started at the top. Let's look at March 2020. In a single week, the market depth for 10-year Treasury notes, one of the world's most important financial instruments, dropped by over 90%. The gap between buying and selling prices exploded. The market conditions were so bad that the Bank for International Settlements called it the most disorderly Treasury market conditions in modern history. And this happened before the stock market crashed, before credit markets sold off, and before any retail panic set in. That is the inversion. The safest assets suddenly became the hardest to trade. Liquidity feels guaranteed, until suddenly, it isn't. So what's the mechanism behind this? It starts with something called dealer balance sheets. Dealers are the market makers. They provide the depth by holding inventory and being ready to buy or sell at any moment. They are the invisible glue that makes a market actually function instead of freezing up. But here's the catch. Their capacity to do this is limited. It's regulated and it's expensive. The U.S. Treasury market is worth over $25 trillion. But the total balance sheet capacity of the primary dealers, the big banks that facilitate this market, is only around $300 to $400 billion. That means a market 60 to 80 times larger is depending on a tiny fraction of capacity to absorb trading flows. That massive gap, that balance sheet mismatch, is the seed of every crisis. In fact, dealer capacity has been flat or even declining since 2015. While the amount of Treasury debt has grown by over $10 trillion. Next, let's add leverage to this fragile setup. People don't just buy Treasuries to hold them. They use them to get loans, to finance other trades, and as collateral. Every single day, over $4 trillion in U.S. Treasuries are used in the repo market. This isn't long-term investing. It's a constant, high-speed cycle of borrowing and lending. And this is where things get interesting. Every one of these financing deals has something called a haircut. It's the extra collateral a borrower has to post to secure a loan. In calm times, haircuts are low. But when dealers start to feel their balance sheets getting strained, they increase those haircuts. A 2% haircut might become 5%. Or even 8%. This does two things. First, it forces borrowers to cough up more collateral, which they might not have. Second, it reduces the entire system's ability to fund itself. This creates a negative feedback loop, and it all happens before any prices have crashed. Now, let's connect these two pieces, the limited dealer balance sheets and the widening haircuts, and add one more layer: value at risk shocks, or VAR shocks. Large financial institutions use risk models that automatically limit their exposure based on how volatile the market is. When volatility ticks up, even just a little, these models force them to sell assets and reduce their positions. This isn't a decision based on fear. It's pure mathematics. A dealer might be perfectly confident about their Treasury holdings on a Monday. But if market volatility rises, their internal risk controls might force them to sell billions of dollars worth of those treasuries overnight. Now, imagine this happening simultaneously across 10 major dealers. This is the precise moment that liquidity begins to disappear from the market, long before a single news story reports any trouble. So, we have our formula: limited dealer balance sheets, plus widening haircuts, plus automatic VAR-based selling equals liquidity being sucked out of the safest assets first. That's the first stage of the blueprint for a crisis. But then we move to the second stage, the part that makes these crises so consistent and terrifying: forced selling and amplification. Once liquidity starts to dry up in the safest collateral, like Treasuries, funding gets tight across the entire system. Hedge funds, mortgage investors, and traders who rely on short-term borrowing are suddenly in a bind. They either need to find more collateral, or they need to get out of their trades fast. This is a structural problem, not a psychological one. And when they have to sell, what do they sell first? They sell their most liquid assets. This is why every crisis starts with strange, unexplained selling pressure in the most important markets: benchmark treasuries, S&P 500 futures, and major currencies. If you look at the trading data, you'll see these sharp moves happen at specific, mechanical times of the day, linked to funding cycles, not random panic. There are 10 verifiable, structural signals that appear before every major modern crisis. These aren't guesses. They're all documented by major financial institutions like the Federal Reserve. First, Treasury market depth falls dramatically. Second, there's a spike in repo fails, which means short sellers can't find the collateral they need. Third, the cost of swapping currencies widens. Fourth, dealer inventory of treasuries turns negative, meaning they refuse to hold them. Fifth, bid-ask spreads in major futures markets widen. Sixth, we see volatility in corporate bond ETFs. Seventh, repo haircuts increase. Eighth, a key banking stress indicator called the Frawley spread jumps. 9th, we see rapid changes in major government accounts, signaling liquidity is being pulled from the system. And 10th, we see a spike in usage of the Fed's emergency lending facility. These signals are real, public, and time-stamped. They appeared before the 2008 crisis, before the 2019 repo freeze, and before the 2020 Treasury market seizure. They didn't show up after the panic started. These signals were the cause of the panic. And now, we arrive at the third and final piece of the crisis architecture: the refusal to provide liquidity. This is the moment in every crisis blueprint where the institutions that are supposed to act as intermediaries, the ones that keep the gears of the market turning, simply stop. They step away. This isn't some abstract theory. You can see it in the data: trace, trade report, limit, order book, depth records, FINRA, market statistics. They all tell the same story. In September 2019, the primary dealers, the big banks at the center of the system, abruptly refused to take on new repo positions. The Office of Financial Research called this a sudden, nonlinear liquidity constraint, a polite way of saying the market just seized up. Then in March 2020, something even more telling happened. The San Francisco Fed published an analysis admitting that dealers turned away Treasury trades they would have normally internalized. Now, let that sink in. This wasn't a case of liquidity disappearing because of fear. It vanished because the dealers' incentives completely flipped. It was no longer profitable or safe to provide liquidity. It was now essential to protect their own balance sheets. To really grasp why this refusal is inevitable, look at the Standing Repo Facility, or SURF, from 2022 to 2024. The SURF was created as a backstop, a safety net to provide funding when the repo markets get tight. But if you look at when it's actually used, the pattern is shocking. It only kicks in after volatility has already broken the market, not before. This means the real pivot point, the moment of inversion, happens when the dealers decide to step back. The central banks only intervene later to clean up the mess. It's a built-in architectural lag. The crisis is always allowed to begin structurally before it's ever addressed politically. So let's distill this entire architecture into a clear, 5-phase process. Phase 1. The liquidity illusion. This is where everything looks fine on the surface. Prices are stable, but underneath, the market depth is getting thinner and thinner. The data to watch here is Treasury market depth, the usage of the Fed's on RRP facility, and cross-currency basis swaps. These are the subtle cracks appearing in the foundation. Phase 2. The balance sheet inversion. Suddenly, the rules of the game change. Lenders get nervous and start demanding more collateral for loans, increasing haircuts. Banks tighten their risk models, their value at risk, or VAR. The data that reveals this is DTC repo haircut data, risk reports from primary dealers, and volatility studies from the Bank for International Settlements. This is the system turning on itself. Phase 3. Forced sequential selling. As the pressure builds, market participants are forced to sell not what they want to sell, but what they can sell. The most liquid assets, like treasuries, become the first things thrown overboard. You see this in trace transaction data, futures imbalances on the CME, and sudden spikes in the premium or discount of ETFs. Phase 4. The funding constraint loop. This is the death spiral. No one will provide liquidity because everyone is waiting for someone else to act first. The system freezes. The key data points here are SURF usage, a spike in dealer fails to deliver, and the Frawley spread blowing out, which is a classic indicator of interbank stress. Phase 5. Narrative lag. This is my favorite part because it's where the story gets written, and it's almost always wrong. The news finally catches up, days after the structural cracks appeared, and invents a cause. A sudden sell-off is blamed on fear, uncertainty, or some headline that actually happened long after the real damage began. By this point, what looks like random chaos is actually a predictable, mechanical process that was already documented in the financial structure, and every single stage is measurable through publicly available data. Now, let's see this exact pattern play out across history. In 1987, A strategy called portfolio insurance created a wave of forced sellers once futures fell. The dealers, overwhelmed, refused to absorb the inventory. Liquidity inverted. The Bank for International Settlements later concluded that market depth eroded before volatility surged. The pattern was there. In 2008, everyone blamed subprime mortgages. But the real crisis started in the short-term funding markets, commercial paper, money markets. They seized up first. The collapse of Bear Stearns was just the visible symptom of a fragile collateral chain that had been under extreme tension for months. And in 2020, the Treasury market, the most liquid market in the world, didn't break because of pandemic headlines. It broke because of dealer balance sheet constraints. The Federal Reserve had to step in and buy $1.5 trillion of treasuries in a matter of weeks, not to fight the virus, but to offset the shock to the banking system's balance sheets. Inside every single one of these disruptions is the same invisible rule. Liquidity vanishes first exactly where it is assumed to be permanent. That's the inversion. That's the repeating circuit. And here is the part that almost nobody wants to say out loud. This pattern benefits someone. The removal of liquidity forces assets to be repriced. It forces policymakers to act, and it forces central banks to intervene. And almost always, the intervention supports the very leveraged institutions that survived the initial inversion. Follow the incentives. Compared to average market participants, those with flexible balance sheets, with access to options, and with a direct line to the central bank's lending window, gain a massive structural advantage when the system breaks. Crisis is not just about loss. Crisis is a redistribution of wealth, triggered by the geometry of liquidity. The insiders, the ones who really understand this, they don't predict crashes by reading headlines. They predict crashes by tracking market depth, collateral, haircuts, dealer positioning, basis swaps, and funding costs. Macro hedge funds, the risk desks at big dealers, the market desks at central banks, they are all watching the exact same architectural blueprint. They know the pattern because the pattern has never changed. The deeper reveal here is almost philosophical. We're taught to think of markets as efficient engines that price risk. They're not. They are networks that balance sheets. Prices are just the reflection of the stress on those balance sheets. Every crisis follows the same path, because the architecture that supports liquidity isn't infinite. It's not variable, and it's certainly not emotional. It is finite, it is cyclical, and it is bound by cold, hard contracts. If you strip away all the noise, the speeches, the headlines, the panic, the politics, a crisis is simply the moment when the incentive to provide liquidity flips into the incentive to withhold it. From that moment on, the outcome is predetermined. Every chart you see, every dramatic price drop, is just the visible shadow of invisible terms that were negotiated in repo contracts and risk systems hours or even days earlier. In the final part of this series, we're going to take this architecture and look forward. We'll outline the warning signals that are already visible today, the structural fragilities that are quietly building in the system, and the one implication that almost no one wants to accept. The next crisis isn't coming. It's already underway, because the pattern is already repeating. Stand in front of any market chart today: equities, treasuries, crypto, credit spreads, and it all looks normally, even optimistic. But the strange thing about repeating crisis patterns is that they never look threatening until they are already irreversible. The surface is always calm because the real pressure is building underneath, silently, like carbon monoxide. You can't smell the tension. You can only see its shape in the system's inability to absorb a shock. And right now, if you know how to read the architecture, you can feel it. Liquidity is thinning in all the wrong places, at all the wrong times, in all the familiar ways. Let us begin with the most uncomfortable truth. Liquidity is being pulled from the very top of the system again. If you look at the U.S. Treasury market, the deepest, most important market in the world, its depth has been steadily declining since the middle of 2023. You can see this in the official data. Volatility is low, which makes everyone feel safe. But the big dealers, the market makers, are refusing to expand their inventories. This is a direct repeat of the exact same setup that came right before the repo market spike in 2019, and the complete seizure in March 2020. This matters because it means we are in phase 1 of a well-worn blueprint, the illusion of liquidity. Prices look stable, but the ability to transact is getting thinner, and everyone is pretending it's normal. Next, let's talk about private credit growth. Statistics from the Federal Reserve show that non-bank lending has exploded, reaching over $2 trillion in outstanding commitments. It's now so large it's eclipsing parts of the traditional regulated banking system. This is phase 2, the migration of fragility. Think about it. Every time regulators fix a problem from the last crisis, they inadvertently create a new vulnerability somewhere else. After 2008, they made the big banks safer. So where did all the risk go? It migrated. It moved into the shadows, into private credit, where there's less oversight. This isn't just a theory, it's a direct lineage. We saw it in 1934, then 1971, then 2008, and we're seeing it again now. The risk always moves to a quiet place, somewhere nobody is measuring properly yet, and that quiet place is almost always where the next trigger is hiding. When it becomes more expensive for international players to get their hands on US dollars, it means the financial plumbing is getting clogged. This is exactly what happened before the 1998 Russian crisis and before the 2008 global financial crisis, when dollar stress first appeared in seemingly unrelated European banking markets, months before it ever made a headline in the US. The problem is starting far away, out of sight. Finally, there's the structural warning that insiders whisper about. It's a phrase that, once you understand it, you can't unsee. No one is quoting size. This is the real, silent alarm bell. You will never see this trending on social media or in a financial news headline. You hear it in the private chat windows of dealers, in risk desk briefings, and on early morning market calls. When liquidity becomes reluctant, it isn't loud. It's hesitant. It's gradual. Phase 2, risk moves into the shadows. Phase 3, funding stress appears offshore. And then the final, internal phase, the quiet refusal to provide liquidity. And then one day, some perfectly ordinary headline becomes the official cause of the crisis, even though the real trigger happened days or weeks before, when the incentives for market makers silently flipped. Hear us the truth that never makes it into the official reports. Crises follow the path of least balance sheet capacity. They don't follow the news. They don't follow the drama. They follow the plumbing. Watching financial plumbing is boring until it becomes the only thing that matters. So, what should you watch? Watch the liquidity depth in US Treasuries. Watch the nearest term repo rates. Watch the cross-currency basis swaps. Watch dealer positioning, but most importantly, watch for the subtle and spoken refusal to provide liquidity at a normal size. Don't watch the prices. Watch the willingness of market makers to even show you a price. If there's one core idea that sits beneath all these repeating patterns, it's this. Markets don't break because people panic. People panic because markets break. The structure dictates the outcome. The underlying incentives determine the timing. Liquidity doesn't just disappear because sentiment changed. Sentiment changes because liquidity has already disappeared. We've just uncovered something that normally lives buried in footnotes, in obscure stress reports, in the unquoted lines of central bank meeting minutes. It's a recurring geometry of collapse. And once you see it, the world of finance feels smaller, simpler, and much more explainable. But it also becomes more disturbing, because repetition implies a kind of design. No single person designs a crisis, but incentives do. Design emerges from constraints. So here is the final insight to carry with you, the one that will change how you look at markets from this day forward. Structural fragility isn't hidden in the price of an asset. It's hidden in liquidity behavior. Look for market depth that suddenly thins without a clear reason. Look for credit spreads that widen without any bad news. Look for funding costs that tighten without a single headline. Look for instruments that suddenly trade strangely quietly. Those are the whispers before the break. When the next crisis finally arrives, the headlines will say it was caused by a war, a corporate default, a pandemic, or a political mistake. But you will know the real cause came long before that. It came from a decision someone made quietly inside a risk system to pull back their liquidity. A signature so small it leaves no trace on a financial news terminal, but so powerful it changes everything. We've opened the file. We've traced the pattern. You can see what connects 1907 to 1929, 1987 to 1998, and 2008 to 2020. It's a shape beneath every crisis, silent, repeating, almost mechanical. The air feels a little heavier now, doesn't it? Something has shifted, not in the world, but in the way you see it. From now on, follow the incentives, not the headline. The next rupture is already moving in silence.